So Brian is, him and I were together. He's obviously a fellow mastermind member. I believe he's number one in the company right now in annuity production year to date. And Brian and I were on a panel of emerging leaders and legends for Forum 400 is how we met.
Yep.
And now we've become good friends. He's a very well-respected, what's your RIA, 200 million?
Yeah, about that.
Yeah, he's got his own individual RIA that's got 200 million of assets under management. And all of a sudden he's at the top of our annuity board, and he's also one of my very dear friends. And
thanks, buddy.
Going to share some great ideas with you. Thank you.
Yeah, thanks a lot. Thanks a lot.
There you go.
All right, here we go. So first of all, thank you for having me out, and Jason, thank you for the kind words. Happy summer solstice day, right? So it's a good day to be in Cleveland. I'm from Houston, so summer solstice is like the hottest day of the year. So glad to be a little bit north of that. You wouldn't take you long to figure out where I'm from based on my accent. But anyway, we're going to talk about annuities today and a little bit about our market, a little bit about our background. We work with really kind of two types of clients. We've got the oil and gas market in the Houston area, so we do a lot of work with corporate oil and gas executives and retirees. So one of the case studies I'm going to talk about is around that. And then the second kind of niche market that we have is we work with McDonald's franchise operators. And so I don't know if any of you guys have had a client that you took on in your practice that you knew one day was going to be a really good client, but when you took them on, they weren't, maybe more of a headache than anything else. So the first case study I'm going to talk about is definitely around that. And so the two case studies, about 11 million in premium that we brought in over the last 12 months with these two ideas. And it's not rocket science, but I'm just going to walk you through it and kind of tell the story how we told it to the client. And hopefully you guys can pick up something from it. But so the first one, McDonald's guy, he had about 40 stores, sold his practice, or sold his entire organization finally, and grossed about 30 million. And so we had, after all the bills were paid, we had about 15 million that we needed to generate income. And so he's, pretty modest in his lifestyle. He needed $50,000 a month to live on, and so we had to kind of we had to figure out how best to do that. And so the risks and the concerns that we had to navigate, obviously we're in a really low interest rate environment. He's very familiar with the bond market and the typical 10-year bond ladder strategy, and so we talked about the risks associated with that and how that gets impacted when rates rise, and we all know that. We talked about the sequence of returns, right? So if we're looking to get a little bit more yield than what's available in the bond market, we can go to equities, but what's the problem with equities? We don't know when those premiums are going to appear, right? So every day, the S&P 500's up about 55% of the time, right? Every year it's up, 7 out of 10? We go out 5 years, we got an 86% chance. So moral of the story is we need to make sure that we have enough time so we can mitigate sequence of returns. Long-term inflation impacts, we could just stick $15 million under the mattress and that would last him 25 years. And he could live on 600 grand a year as long as he doesn't live past 91. So that's an option. Obviously at 91, 600,000 is not going to support his current lifestyle. So we got to figure out a way to get around that. Taxes are a big concern. He just gave away $15 million to his partner, Uncle Sam, so we really want to make sure we can maximize tax efficiency. We talked about market volatility. So income solutions, the typical no-brainer. We can position the entire portfolio to generate 4%. That gets us the income that we need. That's an option. But problem is, if we're positioning the portfolio for a 4% yield, we don't really have any opportunity to grow that capital base. And so then the option that we presented was using the spin down strategy with the 222 product, and he really resonated with that. And so this is just a quick summary of the numbers. On the left-hand side, overly simplified. I mean, we used a complex planning tool to do this called Excel. But it's so $15 million, $600,000 a year. Versus why don't we just take $3 million and reduce the strain on the portfolio. So we've slid over $3 million into the 222 product and spent it down over 10 years. And what that did was it reduced the strain on the 12 million. And so I had a conversation with him. I said, if we're reducing the strain on the portfolio and we don't need to generate 100% of the portfolio doesn't need to generate income for you anymore, can we afford to take a little more risk? And so I got him to agree that maybe a 6% rate of return would be reasonable. And so gross 6% rate of return and only taking 300,000, we've got a net increase in the asset base each year over the course of time. And so at the end of the day, we're able to get the same amount of income, but actually increase his capital base. So what Jason was alluding to is refilling the bucket. So what did we accomplish? We avoided interest rate risk because we've got a fixed asset that we can spend down that actually increases in value if interest rates go up, right? So it's like inversely correlated to how bonds react to rising interest rate environment. And that was really attractive to him because we're on the good side of that equation now. It avoids the sequence of returns risk. And so if we have down markets, we're not forced to sell something at a bad price to generate the income flow that the client needed. So we really liked that. So long-term inflation hedge. The tax efficiency of that cash flow, right? So even using municipal bonds, we've got AMT issues at that level of income and all kinds of things there. And so spending down principal is a very tax efficient way to provide income into a household. And so that was a really attractive aspect of the plan as well. So, and it avoids the short-term market volatility and giving us the time that we need in the equity market, because over a 10-year period of time, the probability of losing money is extremely low if we don't have to draw from that asset. So the second one is in the kind of the oil and gas market. So this is a 60-year-old client, and let me give you a little background of this. I grew up in the AXA career channel, right? So I drank the Kool-Aid right out of school, and they have two products, variable annuity and variable life, and that's what you sold when you're an AXA person. Not saying anything bad about the company. They've got great products, but I drank the Kool-Aid. Jason helped me open my eyes into the rest of the financial market when we went independent several years ago. But anyway, this was a client that I took on back in 2008, maybe 2009, and he was the recipient of one of these wonderful variable annuities. And it did okay for him, but after really looking under the hood and figuring out how these products work, we did a really nice comparison for him. So, there, look, see, purchased it in 2010. So it's out of surrender. He's looking for more income. He's really looking for lower fees because these products are very expensive traditionally. And so his current value was about $600,000. His income base was higher than his value, so we had that consideration to look into. So he had about a $60,000 appreciated benefit base on this contract, and it had a 4% compound guaranteed roll-up on that benefit base every year. It's actually tied to the 10-year Treasury. Some of you guys might know what product I'm talking about, but it's tied to the 10-year Treasury, so it's at its minimum guarantee. So anyway, 4% roll-up. Current fees are at 3.19%. And one of the things that I learned about these products is the fees on them are actually charged against the benefit base and not the account value. And so as the account value depletes, the fees actually go up. And so it really does cannibalize itself over a relatively short period of time, forcing annuitization because of the high cost associated with these products. And so anyway, the same concerns that we had with the first case study. How do we protect against market volatility, long-term inflation, sequence of returns? And so the two options were we could just keep our existing contract, take the $26,000 and change at our 4% roll-up, and over the course of a relatively short period of time, even with good market performance, which you'll see next, that contract value got depleted, and it would have forced annuitization from the client. And so the alternative is to use the 222 spin down strategy. And this is a unique positioning that Nick Mueller helped us with. He said, you can use a hybrid of not necessarily taking a full 10% of the distribution over the first 10 years, just take enough to equal the existing contract guaranteed withdrawal rate and then switch over to the lifetime withdrawal benefit. And the numbers actually worked out really well comparing that. And so if you look at the comparison here, The first year's income on the guaranteed side on the existing contract was about $26,000. And so if we took a free withdrawal from the Allianz 222 at exactly the same rate, that $26,000, we're in pretty good shape. At historical rates, though, you can look out 25 years, the AXA contract's still at $26,000 because the likelihood that you're going to get any kind of increase from that product was like zero. And so even though it's a great story saying, oh yeah, you get an annual reset if the market value appreciates or you get this guaranteed roll-up, the fact that you've got a 3.2% and increasing fee drag gives you a really low chance of probability, especially when you're taking another 4% from the contract. So you've got like no chance of getting an increasing income, whereas the Allianz has a guaranteed increase built into it anytime there's an interest credit. And so anytime you have positive performance in this contract, regardless of the account value, you're getting a bump in your income. And so we really like that. And so over the course of time, historically at least, we've got a chance of getting about $200,000 more income from the new contract than this variable annuity that has really high fees, and so we really like that. The other thing to think about was if we had market value corrections or we made 0% or we made 5%, the Allianz contract actually performs better on the cash value, even at guaranteed rates because of the lower fee. And so that was a big plus. And so we moved the contract and we did it. So in summary, we saved him $21,000 in annual fees, just on the $600,000. We equaled his existing income stream starting in year 2. We provided principal protection against market volatility, so now we don't have to worry about if the account value in the variable annuity drops and we needed a lump sum for whatever reason, we've got that protected. We provided the opportunity for increasing income, and that was really the selling point, is these variable annuities, the chance of you getting any increase is very low. And so in a fixed product that has a zero fee environment when we're negative, to get you an increasing income over time was really attractive. And then obviously the nursing home double was a big selling point for him too. And so these were some of the objections that we went through and that we all face every day. So I just figured I'd give you this and how we kind of react to it. So the expensive objection, obviously how we address that, especially with the 222 product, which we love, it's a true zero fee on the downside, right? We all know that there's a cost associated with the caps and the spreads, but on the downside, it's a zero fee product. And so it is a true principally protected vehicle, and clients love that, right? So you get some upside, but you don't have to give up the downside. Annuities are very illiquid. We sell on this too, that you do have a true 10% withdrawal of principal paid in instead of account value. That's a big selling point over that 10-year period because most annuity contracts are 10% of account value, which is a reducing number if you're drawing it down, whereas the Allianz contract is a level 10% of the premiums paid. I don't trust insurance companies, and this is a relatively new one with the entrance of private equity in our marketplace. I'm not going to mention any names, but know your partner before you sign the contract. Understand the insurance company that you're dealing with, and this is what we have a conversation with our clients. Say, we're doing due diligence on your behalf. We're making sure that we understand very thoroughly who you're giving your money to and what their track record is. And so the things that we look at, financial ratings, we look at Comdex ratings. We look at the state regulatory differences. If an insurance company becomes insolvent, what are the rules of the game, right? And that differs from state to state. And so we pay really close attention to what domicile the insurance companies are operating under. Ownership structure. Is it private equity? Is it mutual? Is it a stock company? These are all factors that we like to try to consider. And then we, through all of those combinations, we try to determine, the best fit. We focus on the long-term distribution rate when we face the I don't want to spend principal, right? We've all heard that from our clients. I don't want to spend my principal. I just want to live on my income. So we really try to pivot that to what is an acceptable household distribution rate, right? And we really focus on that. So even if we're spending down principal in this bucket, if we've got a bucket over here that we're not touching in our later bucket, then we're really not necessarily spending down principal, so to speak, even though we are technically spending down basis to provide tax-efficient income. and to protect against the sequence of returns risk and not having to sell something at a bad price to generate a lifestyle need. So the result of all of this, we've done 4 jumbo cases in the last 12 months with that spin down strategy. The big takeaway I can give you is whether somebody has $15 million to invest or $50,000, if you treat them the same with dignity and don't put them up on this pedestal saying we got to give you something extra special because you got a lot of money. This is simple stuff, and the same strategies work for people with $15 million versus the guys down the street. So I think that's the big takeaway, and kind of the light bulb that went on with me is, don't be intimidated by the big numbers, and stick to your strategy, stick to your principles, because they apply to really every aspect demographically down the road. Second one, because I drank so much Kool-Aid in the first 10 years of my career, we've got a lot of opportunity in the replacement space when it makes sense to get folks out of those variable annuities with really high cost, and we can get them in a really competitive product. So that's all I had, and I'm 9 minutes early, so appreciate it. I'll take questions. Yeah.
I got a question. Bring the first case. Some mics around before you ask a question. On that first case, that McDonald franchisee,
Yeah.
You had 15 million. You said you put 3 million in the 222.
That's right. Yeah.
That generated 25,000 a month for him, right?
Right.
And you said he needed 50.
Right.
The other 12 million
so we invested the other $12 million at a 6% assumed rate of return, but we were only distributing $300,000 to support the other half of his income need.
You said at a 6% rate of return.
That's right.
Did you guarantee that 6%?
No, of course not. We had a discussion about what was a reasonable rate of return to assume, because we only needed to generate a smaller income from that number, from that total number. Yeah.
I thought you'd used a guaranteed product.
No. We had a discussion about what a reasonable rate of return was as compared to a 100% income portfolio. Okay. And so when we were talking about the 100% income solution generating a 4% yield, we said, okay, if we didn't have to generate 100% of, position it for 100% income, what is a reasonable increase in growth rate that we can assume?
Thank you, Brian.
Yeah. Anybody else? All right. Well, thank you very much. Yep.